once again. The Northeast was hit by a storm this week, and so I am back in South Carolina. And hotel is really hard to find, so it's a little bit dark in here, but it's bright outside, happy to say. Our compliance team, given the nature of discussion of video, our compliance team is asked that mention that this video is for information purposes only. ARC may or may not own the stocks that we're talking about. If we do own them, we may own them in size, and all of that is disclosed in many of you, parent, and everything we do. So we're not giving an investor advice in this video. We're not suggesting buy, sell, or hold. That we don't want to straight to with you. Of course, we are very investing to invest in the brands discussed in this video. As we've done in the past, we start with fiscal policy, monetary policy, market signals, economic indicators, and we're going into some positive innovation that came through over earnings calls during the last weeks. So on monetary policy, not much change there. We know that bonds certainly believe that the Fed is going to be backstop for as far as RC, and get into that in terms of indicators later. In terms of fiscal policy, we're still seeing negotiations between the Democrats and Republicans come up with another recovery package, and I do believe that the President Trump is re-entering possibilities. He knows he's not going to get it through Congress. I think he may try to do so with an executive orders, and that may be contested as well. That idea has not died. I thought it had when I spoke last week. And so what happened the added unemployment insurance benefits in this last week. There's a lot of fear that we're in an election here, and so I do think both parties will come together ultimately. Now, as far as market signals, the long-term industries, long-term 10-year treasury dropped back to its closing low in March, and so again that has a lot of people on the edge. They don't want to go back into this, so to speak. The market has been acting a little squishy recently, but if you look at what's going on in the junk bond world, I think this week we passed in terms of issuance the rate revision for all of last year. We did that in last 6-7 months. So the market is open for business. There is not risk aversion taking place here. I just think there is huge appetite for bonds and fixed income. There's still a flow out of equity into fixed income compound way. I actually think that flow shouldn't be going in the other direction if we're right what's happening with this economy. So we thought the S&P 500 up this week. It was up about 2.5%. So when I say the market is acting a little squishy, it's probably in more of a higher multiple stocks. What we're beginning to see is cyclicals outperforming. Makes a lot of sense. It didn't happen earlier, but to give you an example, the top performing sectors this week were industrials, communication services, including Facebook, technology, and discretionary. Cyclical sectors was performing were real estate, services, healthcare, utilities, and staples. those are more defensive groups. So I am pleased that we are seeing this all market expand to more value-oriented sectors, certainly more cyclical sectors. The most unhealthy part of the last few months is that value stocks were left out of the rally, and our explanation is a lot of value companies are in harm's way because all of the disruptive innovations taking place. And as you know, research disrupted innovation day in and day out. It's very clear to us that financial services, energy, healthcare companies that do not adopt new technologies, industrials which are centered on the internal combustion engine, that all of this honestly, and we do believe that will be disrupted over time. That doesn't mean that that very big cycle ever recruit is going to cycle. Been saying for some time V-shaped recovery, and we will, when we get to economic indicators, that go through some of the indicators that are starting to reshape out. Just one of their comments I like to make, the dollar, something watching there carefully. It has settled down, it hit no lows, at least in recent terms. If you historical perspective, it's hardly moved out of the recent trading, starting to break down the level of the past years. We are on dollar. What the dollar is a good gauge on confidence and the U.S. economy, and it is also a gauge of whether or not our monetary policy is more inflationary than monetary policy abroad. So happy to see some stabilization. Gold prices on a new high. Again, not so question mark about this. Is this indication that inflation is about to take off, or is it simply a commentary of how low yields are and how low the opportunities cost investing in gold is? So, and the other inflation hedge we pay a lot of attention to, as you probably know, is Bitcoin has had breakout in the last few weeks. It looks like it's in the 10 to 13,000 range with 12,000. And the 13,000 is important because we'll get through that. Then, in technical terms, there will be the resistance, it would probably be on our back to the peaks we saw in late 2017. They're around $20,000. We're not sure if it's going to happen. New trading range, just a little bit on higher level. The recent 6 to 10, or maybe we're in the 10 to $13,000 range. Nonetheless, breakout. And is this another inflation hedge starting to speak volume about the risk out there? We do think that investors in both gold and digital gold, Bitcoin, are taking out of insurance policy. Makes sense because we are so much in the waters. And after the 9 on charge of water, when the U.S. Central Bank reserves after the monetary base $4.5 trillion from $150 billion. Now that did not inflation, as we all know, 10 years later. Now we're going up to $9 trillion. Would that cause inflation? Are we in a spiral like Japan has seen in the last 30 years? Very hard to say. Mentioned before, we don't think we have any inflation near term, but the more complacent investors become about this, more I will start to worry. Right now we have too much productivity growth, V-shaped recovery coming from technologically labeled innovations to see inflation taking off. So oil prices still 30% tapered roughly this time last year. So that's another deflationary undercurrent tugging at the inflation indicators. There was a very interesting announcement this week by a company called MicroStrategy, MSTR, and it announced use half of its roughly $500 million in cash and put it into alternative investments, including Bitcoin. So I looked through to see who was making this decision, and what I found was, at least from the CFO's vantage point, he has seen the ravages of hyperinflation and destructive monetary policy. He was at Maxtel Wireless in Brazil, I think during the European sovereign debt crisis when emerging market crises were selling off. And he probably understands the risks associated with monetary policies going wrong. You may think that monetary policy is wrong, though it's important to in time to at least put influence some insurance policies toward again destruction and purchasing powers. That's what I thought share with you. As far as the economics indicators, well, the important the week was unemployment report today, and the unemployment rate continued to fall, or better than expected report, from 11% one per 10.2%, and we saw average turn after certain serious decline. So that was good to see. Last month was minus 1.3%, that's month-on-month. This month, meaning July, was up 0.13%. That was very good. Are telling us something very important. Third quarter GDP. If they were at the end of the July, what we can find is that average hours work would increase from the second quarter to the third quarter at a 22% annualized rate. I think they're going to continue to rise, and we believe that output per man hour is also rising, perhaps at various trends. So it is third quarter GDP could be 30%, could even be 35%, and most economists are expecting something within the 10 to 25% range. I have seen 1 and 30 to 40% rise. Certainly would be high expectations, and again would pick volumes about V-shaped recovery. We also this week got a very interesting number out of the purchasing managers in that, the PMI, and it was higher than expected. It was about 50. That means the industrial world is expanding again. But if you look through the cost of the report, we would have found the orders in the PMI were up to well over 60, and you had to go back to 2018 to see higher numbers. Now, what this tells us is inventory have been declining, have probably hit too low a level, perhaps much too low a level. The businesses is beginning to scramble in order to catch up with demand. So that was very interesting. We also saw manufacturing hours worked in July 1.8%, very strong, and overtime jumped dramatically from 2.5 hours to 2.8 hours. Again, this is another sign. See, 3.3 hours jump in this metric. It is another indicator that is scramble underway, and that businesses are trying to keep up with demand. So with that, I like to go through some of the information we received during earnings, the seasons, and I will start with from some bad news. Illumina reported last night was report that disappointed severely when it sold down 25%, and despite the fact that DNA sequencing was essential to understanding the genome of the virus, and DNA sequencing is it's getting more involved in diagnostic testing. That's very early stages. One of the things that we believe is going on here is that Illumina, which its machine account for at least 95% of all of the basic pairs of DNA sequence around China today. And we've been a little concerned over the past few years that the cost of sequence of whole human genome has stabilized around $1,000. Now, according to our research, DNA sequencing technology is following a cost curve, one of the stiffest seen in at least my experience watching innovation. And as you know, rice is at the heart where rice law says every cumulative doubling in the units of produce cost drop, and a consistent percentage rate. Now for DNA sequencing, we know that the rate is 40%. Now last year, 2.6 million whole human genome sequence, and we know for oncology alone, demand for sequencing is exploding. But we hear from other companies with this molecular diagnostic companies that Illumina is not passing along or not pushing out in products fast enough to enable these cost declines. I was worried about prices stabilize in technologically enabled space, unlike DNA sequencing is. On the road call last night, versus the CEO, they say that they were going to speccing down DNA sequencing cost $600 genome. And we believe that this is important breakthrough. We actually have been concerned that other companies are starting to work around Illumina in order to cost. We are concerned that China could come out with a viable alternative to Illumina, and so we are happy to see that there are getting in terms of cost clients. While the stock has really reacted to very badly to the risk report, unless we think that new price information is important, we hope that this is focus on price in terms of intensifies here, because in our view, the genome revolution has begun. Think about it, just 2.6 million whole genome sequence last year, and rice does based on cumulative doubling. In no time, we're going to 5 million with all of the population sequences and studies taking place out there. And we do think we're going to unlock the code to life and death much more quickly as they come down. And we will with the conversions of DNA sequencing, artificial intelligence, and CRISPR gene editing. We're going to be able to choose this, and confidence in that is increasing, but the starting point for it is the sequencing. So we're happy that Illumina is getting a message that they has got to move more aggressively down the cost curve that it uniquely is enjoying these days. Another report that came out in the next week 10 days was product labs. As you know, on this YouTube channel, we have focused on product lab being a prime beneficiary of supply chains moving back closer to the users and China. And we are also focused on the new technologies like 3D printing that will enable us. Pro labs are both picture manufactured printing, and its report was disappointing as well, especially because we thought if we're right in the future recovery idea of Proto Lab, which has seen it before other industrial companies, and while there seems some improvement, they were enough to go ahead and say this recovery has been to in fact halt. ProLab CEO came out and said V-shaped recovery, saying economic indicators that suggest that businesses in particular, really behind the curve. Why is ProLab not seeing the V-shaped recovery? Well, it could be inventories continue to spiral down in the second quarter, and we did see that in the GDP report, massive inventory liquidation, and that once the scramble is on, ProLabs will see it. I'm just surprised that they're willing to have seen anything in the third quarter. So I wanted to let you know, since we do have this V-shaped recovery point of view, there is company rules that out there who's not seeing it or willing to see that in the third quarter they have started to see it. We got online education news for 2U, and what we learned was there has been acceleration in their revenue growth or organic making some acquisition. So went from 18%. We believe this is just the beginning of a massive shift of education online. One of the pieces of evidence that they have given to us, they gave to the report, was that Get Smarter, their short courses, those increased 97%. They accelerated. I forget what pace they were growing. Nothing near doubling or yearly basis. Interesting about short courses, they're going to start repurchasing them for graduate education, undergraduate education, and for corporations. And I heard from one of our analysts, James Wang, who's our artificial intelligence analyst, who has headed our podcast initiative, that short courses are probably going to start competing with podcasts because he says he's spending tremendous of his time now sampling all the times of short courses. So that was very interesting. So there is another report this week, and what we learned about non-important 7% adults. This is a survey that Zillow did. 75% of adults would prefer to shop online for real estate, and they would be very open to Zillow offers, which is a service by which Zillow says to a person thinking about buying a new home or you're going to sell your home, we'll help you sell it so that you can buy a home quickly. And that is starting to take off. What they're also doing is really, this is another example of vertical integration. We talk about that becoming very important edge, because especially any business harnessing artificial intelligence at all, businesses should be doing that. But what they're doing is taking the friction out of the home buying and selling process, not really buying and selling, but buying, renovating, and selling. but also now they are offering title services, mortgage services, and all the pain points that we go through when we're buying or selling a home. And I think they're big, so they have a nice upside surprise in their report as well. Square, I think this is a shocker to many people. Square's claim to fame this in the early days was in enabling small businesses to use cell phone in just a text where they could put a credit card charge through it. And so most people thought Square was mostly in the physical space, physical open space. What's happened before coronavirus, while it has been in the physical space, their gross purchasing volume online, I believe, was of 50%, and now it counts 20% of total GP, 25% of total GPP. What an incredible transformation it is that has become. And we also saw from the payment protection program that the government Square and other fintech providers were able to execute much more seamless than traditional banks. The Square issued 80,000 loans through that program, and 60% of those loans were to businesses that had never taken a loan from Square before. And as we mentioned before, they were able to process profitably loans and loans 5,000, 7,000. I think they're representing almost 11,000, whereas the average bank loan size was roughly 10 times that amount. Banks can go much lower than that because not profitable. Online makes such a huge difference. Roku is active user base for 40%. Another indicator that entertainment at home connected TVs. Roku being the operating systems for all streaming services. That Israel is trying to record some news. It was forced by the U.S. government that TikTok is, if it wants to remain a service in the U.S., that it is going to have to be bought out by U.S. company like Microsoft. We know that they have a stunt, at least also President Trump has said. Otherwise, it's a done in the U.S. And we have just Nick Bruce, who's analyst on TikTok and online media, did just wrote a paper in a blog art this week, and it gave a lot of statistics about TikTok really becoming all the range and becoming very addictive. Well, now that Facebook understands how successful this has been and introduced Reels, REELs, this week to compete against TikTok. Our analyst, Mike again, started out, he was just as addictive. In fact, many of 15-second videos on Reels have been imported from TikTok. So we would not be surprised to see Instagram take over here in a way that they did with stories from Snaps. They basically imported the idea that Snap gave them, and they took the lion's share of the market. So very interesting. Now, Reels is not introduced as early as Snap has introduced its service. If Reel has started up a year ago, then they really would have something. Could it be a relevant food fight here? Microsoft does get TikTok and Facebook. We think that the risks that associated with transition like that are probably going to give Facebook much more of an edge, and Instagram by Facebook much more of an edge. Realize that otherwise it would have been the case. And the last thing that I'll focus on once again is Bitcoin, and we're about to put out within the next few weeks, probably late August, early September, a new white paper Yasin Mandra has penned. It is a follow-on to our paper called Bitcoin Ringing the Bell from New Asset Class. And we're working with Coin's metrics fair, and I think the paper is quite elucidating and a good read. One of the things at the focus with Bitcoin on is change. I've been very interested in it. Now that more Bitcoin transactions take place on the Ethereum network than on the Bitcoin network, which has caused all kinds of interesting discussion and debates at ARC. And we can say it's win-win, or we can say it's, oh my goodness, there are security issues now, Bitcoin network isn't because of it. And from either point of view, Bitcoin, the default currency here, the reserve currency, and now they're even being used in the network Ether, or the velocity of Ether go up, make price appreciation to potential much less. So stay tuned. It's a live debate. It's fun. I love these changes that battle test all of the thinking. It's just what we do, innovations. Stay tuned, and we'll look forward to sharing all of our ideas and research in the coming weeks or months. Thanks very much.